Yeah, so let's continue from last time. I think we got somewhere here where we were saying that normally if the the risk is high for an asset, the return also tends to be high, right? And this table, of course, it's not a perfect um relationship between the returns and then the risk. Okay, here we are using the standard deviation of the asset to measure risk. So let's say if we have two assets, one asset is like this over time, and then another asset is like that, let's say over time. Okay, clearly this asset has more variation, right? So this standard deviation for the green asset will be more than the standard deviation for the black asset. Okay. And in finance, we use the standard deviation to measure the level of risk, okay, in that asset. And if you should compare, you can see that normally, okay, if the risk is low, the return is also low. Okay, if the risk is high, the return is also a little bit high. Okay, but as I was saying, this is not going to be a perfect relationship. So let's say if I put risk here and I put returns here, for example, let's say this is this is uh let's say 20, somewhere 20 returns. The highest is like 16, so let me make it 20, and let me make it this one, let's say 30. Okay, and if we should plot, okay, this column against this column, overall the relationship will be uh positive, okay, but it's not going to, all the points are not going to lie, even close to the line. Okay, so overall the relationship between returns and risk is positive, but it's not perfect all the time. Okay, and I think we also started talking about the fact that if there is risk, then yeah, there have to be a premium for that risk. Otherwise, investors will not want to invest in that asset. Okay, so if there is a lot of risk, then there should be a risk premium to attract investors to invest. And there are different forms of risk premiums. Okay, so for example, long-term assets have higher risk, okay, than short-term assets, and because of that, there is a term risk premium. Okay, and also comparing corporate assets like corporate bonds to government bonds. Government bonds are quite safe, right? If the government borrows your money, you know for sure that the government is going to pay back. Okay. If the government has no money, it will just print the money. So yeah, the government uh the government bonds here are very safe, and because they are very safe, the risk is low, okay, than corporate bonds, which has a higher risk. But what is the risk premium here? It's about 0.3. Okay. That is between corporate bonds and then government bonds. So maybe not so big, all right? The risk premium is not so big compared to the term risk premium here. Okay, but yeah, it is true that generally government bonds have lower risk and then they have lower returns. Okay. And if you work for some company, you want to raise money for the company, you should be willing to offer this extra returns to attract investors from buying government bonds to buying, your corporate bond. And there's also equity risk premium. So here, big companies like big corporations, comparing the stocks of big corporations to corporate bonds, the stocks here are more risky than corporate bonds. So just comparing the two, okay, this is less risky and then this is more risky. So if it's more risky, there should be a risk premium to attract investors. And on average, it is about 5%. And then we can also compare the stocks for large companies to the stocks for small companies. And normally, small companies are riskier than large companies because small companies, they are just starting, right? So a lot of people may be skeptical whether they will succeed in the long term or they will not succeed. Okay, large companies have already matured into, they've already matured as big corporations, so there isn't a lot of risk if they issue, let's say, stocks or bonds. But many small companies do collapse, and yeah, there's a higher risk in lending money to a small company. So if you're a small company, you want to borrow money from the stock market, you should be willing to offer a higher return by how much? Maybe about also 5% than big corporations. Okay. So that means that overall, small companies faces a higher cost of borrowing, either from the banks or either from the stock market. And as an investor, of course, where to invest your money will depend on your level of risk. Okay, if you have a higher, or if you can, if you are less tolerant to risk, yeah, you can put your money, in the stock for a small company. Okay. The risk is high, but also the returns is higher as well. And sometimes, as an investor, you may also want to predict where the price of the stock or the asset is going to go in the future, so that you can decide which asset to buy. Okay, maybe you may even want to buy an option. Okay, and which option you buy will depend on your belief of where the price is going to go. Okay. And sometimes it's better to base your belief on a model. Okay. There's this quote that all models are wrong, but at least some are useful. So every model you build, whether it's a structural model or whether it's a statistical model, it's not going to be perfect. Okay, you put some inputs into the model, you get some outputs, and let's say you are predicting the price of the stock. So the output here will be the future price. Okay, and it's not going to be perfect. So if it's not perfect, in a sense, it means that the model is wrong, right? It didn't correctly predict the asset, with a high level of accuracy. Okay, so maybe yeah, we can say the output is wrong, of course, if it doesn't exactly match the actual output. But even though models are wrong, but some of them are very useful if we indeed do the modeling well. Okay, some of them cannot predict exactly, but it can get close to the actual figure. Okay. And in this class, of course, we will be also using models. Okay. Maybe we will be building forecasting models. And one simple forecast model is like a regression model. So I don't know if you are familiar with a regression model. So let's say you want to predict the return of some assets in the future. So we are currently at time t, and the future is like time t plus 1. Of course, it can also be time t plus 2. Okay, but let's say we want to predict the price of the stock next period, and let's say assume that the time frequency here is 1 month. Okay, so our returns is like monthly returns, and then we are currently in February. Okay, so we want to predict the return for March and then take a decision. So we can run a regression. Maybe the return for this stock is going to depend on, of course, on its own history. Okay, so this is the history, or let me say one history of the stock. Okay, what is the return today? And yeah, that this return today can have an influence on where the return is going to be in the future. Maybe we can even add more. So let's say alpha 1, alpha 2. We can add more history. Okay, let's say t minus 1. So this will be the return in the last month. Okay, so this is return for March. Okay, we can use return for February to predict the return for March. We can use the return maybe for January to also predict the return for March. Okay, we can add more history, but normally the effects, okay, if we go so far into the past, the effect here kind of declines, okay, to almost 0. So normally we don't want to go so far into the past, but actually when you are building the model, the model can tell you whether this one is a significantly 0, okay, or different from 0. If it's not, if it's significantly different from 0, then yeah, we can include, okay, this past or this history in our prediction. Otherwise, if this is close to 0, this effect here is close to 0, then yeah, we can drop, okay, this history because it has no effect on the prediction. Okay. But we can build some model like this and then use for prediction. So let me drop this one. And of course, we can add other variables, right? Let's say we can add inflation. Okay. Inflation today, maybe inflation yesterday. We can add so many variables to the model. Okay. But let me stop here. Okay. So let's say we have this simple model, and that model can we want to use that model to predict returns for next period. After building the model using historical data, Okay, so this is the future, and R1, RT minus 1, inflation today, they are all historical data. Okay. After building the model, sometimes we have to adjust the model for economic conditions, because economic conditions in the future can change. Okay. And if our prediction is based on the past and something changes in the future, then our prediction here is going to be wrong. Okay. And wrong prediction means that we are going to make a loss in the market. Okay. So sometimes what people will do, for example, and of course this is just one example, right? There are many things you can do, but one thing you can do, for example, is say you can add future inflation, okay, so T plus 1, okay, to the model. So this variable here is future inflation. And then you can, after building the model, you can try to predict, okay, what inflation is going to be in the future. Okay. Maybe based on your own belief about economic conditions in the future, you can predict, okay, what inflation is going to be in the future, and then that prediction will be captured in your prediction of this future return. Okay. So in the main point here is that in building let's say a model to forecast the returns for an asset, we shouldn't only consider, okay, historical data, but we should also try and incorporate, okay, changes in economic conditions, especially economic conditions in the future. Okay. And of course, we can change this return also to price. Okay, so instead of return, we can be using price. Okay. And forecasting, of course, is a big part of investing, because normally the decisions you are going to be making is going to depend on your belief about movement of the price. Okay. If your belief is that the price is going to increase tomorrow, then you will buy the asset. If you believe that the price is going to fall tomorrow, then you will sell the asset, for example. So prediction is very important. Okay. And there are people that their sole job is to forecast the future. Okay. And then there are also indices, okay, in the financial world. Okay. So we can use indices to quickly know how, let's say, an individual asset is performing, or let's say a group of assets are performing. Okay. So we can build an index, let's say, just for a single asset. Okay. And then we can easily know how the asset is the value of the asset is changing over time. So this is an example of such an index. Okay. Let's say the price of the asset is moving like this. Let's say this price is like 5 USD. Okay. This price is I don't know, like 15, okay, USD. Sometimes people want to um use an index to easily know how the asset is doing in terms of percentage, in terms of percentages. Okay, so for example, they will normalize, okay, this price by, let's say, $5, okay, and that will be one, and then they will normalize, okay, this price also by $5, and that will be 15 by 5 is 3, okay, and then they will multiply the 1 by 100, okay, they will multiply the 3 by 100, so we have like 300 and 100. So here we are just dividing, the price, each price by some base value, and that base value is 5. Okay. And then, yeah, if this point is 100 and this point is 300, so percent, we can say that, this asset price has increased, okay, from this point to this point by 200%. So it's easier to sometimes it's easier to analyze, okay, sometimes in terms of percentages than in terms of the real price of the asset. Maybe here it's easy to see that the asset has increased by 3 times, but let's say the price here is like 6.242 and this one is like 7.134. Okay, it's not very comfortable to see in terms of percentages how much the price has changed just by looking at these values. Okay, and then we can convert this to some base value like 100. Okay, and then we can easily see how this value has changed to this value, okay, in percentage forms. Okay, so sometimes, yeah, we can use an index for a single asset to easily see how the price of the asset is changing over time. And there are also indices for a group of assets. So, for example, in the US, there is the Dow Jones Industrial Average, okay, which is a price weighted index for 30 assets. Okay, and this is how it is computed. So the assumption here, okay, in computing this index for 30 assets is that it is assumed that the investor buys one share of each stock. Okay, so if we should expand this one, it's like P 1T times times 1. This one is coming from the fact that we are assuming that the investor is buying just one share of each stock. Okay, so plus, let's say, the price of the second asset times 1. Okay, because again, the assumption is that the investor is buying just one share of each stock. So we can add until, oops, yeah. So we can add until we get, let's say, the price of the 30th asset. Okay, so P30T times 1. Okay, and then, yeah, we divide the whole thing by this is called the divisor, and it's not very important. Okay, it has no economic meaning, but sometimes if an asset is moving this way, and then let's say the company decides to um issue more stocks, okay, is going to, let's say, cause the price of the asset at that point to decline because of the new issues. Okay. So sometimes, let's say, a company has already issued like 100 stocks, okay, and the price of each of the price per share, okay, is moving this way. And sometimes the company may want to issue more shares. Okay, so let's say from 100 to 200. Okay, so what they can do, for example, is break these 100 as assets. Okay, break each one asset into two. Okay, so that they can have 200 assets. If you do that, of course the price of the asset is going to decline. Okay, and maybe it's gonna continue that way. And the Dow Jones index, they want to get rid of this decline here, for example. Okay, they want the price of the asset to be smooth, okay, without this thing here. Okay, and that is why these they have to adjust the price such that the asset moves like this way instead of that way. So this is just there for such purposes. Yeah, so the Dow Jones index assumes it's a price weighted index, but what are we weighting? Okay, so we are weighting these one share for each of the 30 stocks. Okay, that is what we are weighting. Okay, and the price themselves are the weights. Okay. So yeah, if the index is going up, of course, it means that these assets in this group of 30 stocks, okay, they are doing well. Okay, if it's declining, then they are doing bad. Okay, but the problem, maybe it's not a problem, but a disadvantage here is that it means that if the price of some asset is very big, okay, it will have a bigger influence on the index. Okay, let's say the price for Apple stocks is like 20 USD per share, and that for, let's say, Facebook, let's say is $2, right? If there's a change, okay, in the price for Apple stock, of course, it will have a bigger influence. Okay? If this increases by 100%, the effect will be bigger than this increasing by 100%. Okay, even if this one increases by 300%, okay, the effect on the index may not be that significant compared to this price, okay, increasing by a lower percentage. Okay, but yeah, that is the Dow Jones index, and yeah, if normally it's used to capture the top 30 companies, how they are doing in the stock markets. Okay. And in Japan, there's also the Nikkei 225 index. Okay, so here the number of assets in the index is 225 and not 30. But the approach, the how it is computed is the same thing, just that the number of assets has increased. And then we have the S&P 500. So here, the only difference is that instead of assuming that the investor buys just one share of each stock, we are going to assume that the investor buys different quantities, okay, of each stock, and then we are weighing these quantities, okay, by this price here, and we sum the price times the quantity. So the price times the quantity is the market cap, okay, the market capitalization for the individual assets in the index. Okay, so let's say P1T times Q1T is the market capitalization for asset number one. Okay, and then plus P2T Q2T is the market cap for asset number two. So we do this until we get to asset number 500, K500T, Q500T. And then, yeah, the divisor here, it has the same interpretation as I said before. And yeah, that will give us, the S&P 500. Okay. And this is this captures, overall how the market is doing, okay, how the stocks on that exchange is doing. So the S&P 500 is for some exchange, for the New York Stock Exchange. I think the Dow Jones is for a different exchange. Okay, so every exchange has its own index, of course. They should. And if you are a company, you can list, okay, or you can enlist on several exchanges. So overall, the S&P fluctuates, but almost all indexes, okay, goes up over time in the long run. Okay. In the long run, every index, goes up. Okay. Or let's say every index has an upward slope over the long term. In the short run, yeah, if there is some disaster, if there is COVID-19, if there is some financial crisis, the index may decline, but over many years, the index, goes up. And that is why some people or some investors want to be long-term investors. Okay? They don't want to be trading in the short run because the risk here trading in the short run is high, right? You could easily lose your money, but in the long run, okay, you know that the price of some asset is going to go up in the long run. Or let me say the index, okay, overall, okay, is going up, it's trending up in the long run. And there are some mutual funds that try to come up with some portfolio of assets that will follow this, this index, okay? And you can buy that portfolio of assets, and because that the returns for that portfolio of asset is mimicking this S&P 500, it means that, over the long term, the value of your investment is going to go up, okay, in the future. Okay. And like I said, every exchange has their own index. So aside stock indices, we also have bond indices. Okay, so the only difference here is like instead of stocks in some index, now we have bonds in that index. Okay. And this is an example of a bond index. Okay. Here they are weighing or they are normalizing by the value in the base period. Okay, so this is the base period in period 0. Okay, the value of the index in the base period. So that means that the index will look something like we are going to have 100 here if we are multiplying by 100, or we're going to have 1,000 if you are multiplying by 1,000. And then yeah, we can easily see in terms of percentages how the bond index is doing over the long term. Yeah, so some bond indices, I think this is the last slide. So this is an example of a bond index, and yeah, it uses different types of bonds, okay, to compute that index. So it comprises of short-term bonds, long-term bonds, different kinds of bonds, corporate bonds, government bonds, okay, to come up with that index. So you can see it's a very broad index, but we can also build, let's say an index for just government bonds, or we can build a bond index for only corporate bonds and so on. Okay. So that is the end of our discussion for financial assets or financial securities. So let me move to the next topic, which is financial market. So we have discussed different financial assets, and these assets, of course, they have to be sold in the market. So we will be discussing how the market works in general. Of course, every country, the market is going to work slightly differently, but there will be, or let me say, there are many similarities how the financial market works in most countries. So in the market, the type of the market is going to determine a lot of things. Okay. It's going to determine, for example, your trading cost, okay, the speed at which information is captured in the price, okay, the price and accuracy, and how often trading is profitable. So let's say we can, if we compare the stock markets in, let's say, in Africa, in African countries, to, let's say, in developed countries, okay, comparing these two, okay, we already know that the African market is not very efficient, right? The market in the developed world is more efficient, and these things have an effect on trading costs. Okay, so because the market is not very efficient here, it means that the trading cost is also going to be higher okay, in this market than in this market. Okay. The speed at which information is reflected in the price is going to be very slow in the African market, and it's going to be higher relatively for the developed markets. Okay. Pricing accuracy, of course, there's going to be more it's going to be more accurate in developed markets than in developing or less developed markets. And again, more profits are likely to be made here than here. Okay. And probably that is why most stock markets in African countries, or more broadly in less developed countries, are not really competitive. Okay, they're not really functioning well compared to the markets for developed countries. In Ghana, for example, I think it took about 7 years, okay, for um a new company to list, okay, on the Ghanaian stock exchange. So it's not very competitive, okay, and probably because it's not very efficient, and if it's not very efficient, it's going to affect all of these things. Okay. But aside these differences, a lot of things are very similar. Okay, so if you are a trader or an investor, you want to invest your money in the stock market or in the bonds market, the the process is almost the same. Okay, so of course you have to open a brokerage account with some broker. Okay, and then you have to specify which asset you want to buy, whether you are buying or you are selling, how much, okay, you want to buy, and then the order type. Okay, so here we have two types. We have the market order, and then the limit order. So what do we mean by market order? So here, um, if you want to buy or sell in the market and your order is like a market order, um, your um, let's say you want to buy, okay, your order will be executed, okay, at the next best available price. Okay. And here, this best available price is the market price. Of course, at that point in time, okay, if you want to buy now and your order here is a market order, then your order will be executed at the available market price. Okay. If the market price is 80 USD, okay, this is the price that your order will be executed. Okay. So at any point in time, okay, there is some price in the market, and if you want to buy or sell, okay, and your order type is a market order, then yeah, your order will be executed at that price. Okay. And uh talking about the market price, in either market there are two sides of the market, right? Whether it's the stock market or whether it's the goods market, there are always people that want to buy, okay, the demand side of the market, and people that want to sell, the supply side of the market. Okay. So for people that want to buy, okay, how what the price at which they want to buy, we refer to that price as the bid price. Okay, the price at which the market wants to buy some asset is called, the bid price, and the price at which the market is selling the asset is called the X price. Or let me say the price at which the market wants to sell the asset is called the X price. Okay. So this is more like the market buying price, and this is more like the market selling price. So if you want to sell, then you will sell at this bid price, okay? Because this is the market buying price, okay? So if you want to sell, this is how much people want to buy, so you will sell at the bid price, okay? And if you want to buy, um, this is how much, okay, the market is selling the asset, okay? So if you want to buy, you will buy at the X price, okay? So if you go to the market and then you want to buy, yeah, and assuming the X price is 80.30 USD, then you will buy at the X price, okay? And then you will sell at the bid price, okay? And of course, the um the bid price, okay, is going to be smaller than the X price, okay? So the bid price is most times smaller than the X price. And the reason is simple, right? Normally, people want to buy cheaply, but everybody wants to sell, okay, um, at a higher price and then buy at a lower price, okay? And again, this is the market selling price, and this is the market buying price. And normally, people want to sell at a higher price and buy at a lower price. Actually, that is the only way you can make a profit. Okay. So the difference between the ask price and then the bid price here is called the bid ask spread. Okay, and normally it is positive because the ask price here is more than the bid price. Okay. And it is important to note that if you submit an order to the stock market, your order does not, Im immediately execute. Okay, sometimes there is a little bit of a delay. Okay, for example, if you want to buy at some price, but there's nobody willing to sell, then yeah, um, your order would not be immediately executed. Okay. And sometimes you can even make a loss, okay? Because the price of the asset is changing all the time because supply and demand is changing um all the time, okay? And especially if your market order was like if your order was a market order, then you know your order is going to execute at the next best price. Okay, so even if this price will lead to a loss, your order is going to execute anyway. Okay, and then yeah, you can make a loss. So let's say you invested 80, okay, and by the time you were investing the $80, let's say the price was like 81. Let me use 81. Okay. So this was the price at the time that you sent your order, okay. But by the time that your order was executed, the price has fallen, let's say to 79. Okay. So in that case, your order will still execute, okay, but because it is now executing at this price, you will make a loss, okay. So there are some, especially in people that, they trade, you have to make sure that, your your PC or the computer you're using has, a very high uh, speed, okay. Your internet, is not slow, because if it is, it, it can increase your risk of making losses. Okay. So there's also limit orders, and that is different from market orders. So why is it called limit order? Because you can limit your losses. Okay. So here you can specify um some limit price, okay, you want to sell, or some limit price you want to buy the asset. Okay. And of course, if you are buying, if you're on the demand side, normally you want to buy low, right? You don't want to buy high. So you can um put a limit, okay, some upper bound above which you don't want to buy. Okay. So there is a maximum price you are willing to buy this maximum. If the price of the asset, exceeds this limit, your order here will not execute. Okay. In if your order type is market order, then even if the price exceeds some limit, yeah, your order will still execute. Okay. But for limit orders, you can put like a cap above which you don't want to buy, because the price is too high for you. And then if you are selling, okay, sellers want to sell high, right? So you can put some lower limit below which you don't want to sell, because if you sell below that limit, maybe you make a loss, right? Or you will make less profit, okay? And you can put some minimum limit below which you don't want to sell, because the price is too low. Okay? So you can set a sell limit, and you can set a buy limit. So here are some examples. Let's see. So let's say you put in an order to buy 100 shares, okay? And the limit here is 75. So as long as the asset price is below this 75 limit, your order will execute. Okay. But yeah, if the price moves about 75, then yeah, your order will not be executed. Okay. And if you want to sell, and then the limit is 85, okay. As long as the price is above 85, your order will execute. But if it goes below 85, then your order will not be executed. So one feature of limit orders is that the execution is um uncertain. Okay. Although you can control the price by setting, some upper bound or a lower bound, okay, but the execution is uncertain because your order will only execute, okay, here if we are below, let's say the buy limit, or if we are above the sell limit, okay. So if the price is here, then the order will not execute, and if the price is here, it will not execute. So it's not always certain that your order will be executed or not. Okay. If your order is a market order, then it will, you know, with a high probability be executed because you are buying at whatever price exists in the market. Okay, if your order is a market price, you are buying at whatever price exists in the market. So your order will be executed. But if you put limits, then the execution of your order becomes uncertain. Okay. And in um in trying to benefit from, let's say, a decline in the asset price, okay, you can um do something called short sales. Okay, that is, this only works if you predict that the price of the asset is going to decline. Okay. You can short sell an asset. So what does it mean to short sell an asset? It means that you can sell um an asset you've borrowed, okay, and then yeah, if the price declines, okay, you can make a profit. So again, let's say your prediction is that the price of the asset is going to decline, okay, so you can borrow, let's say, 100 um shares, okay, and then sell, let's say the price of each share is 100, okay, so your um the market value of that asset, okay, is 100. The money you make if you sell is 100, okay. And let's assume that indeed the price of the asset declines to 50, okay. Sorry, not 50. Okay. So here the price of the asset is 1, okay. The quantity, the Q here is 100, okay. And then if you sell 100 shares at the price of 1, then you receive, let's say, 100 USD. And let's say the price of the asset declines to 0.5, okay. You can buy, okay, at this point, you can buy the 100 assets back, right? You can buy, and if you buy, the price for the total 100 now will be, 50 USD. Okay. And then the difference here is going to be your profit, because, what you are essentially doing is that you are buying at a cheaper price, okay, and you are selling at a higher price, okay. And the difference will be your profit. Okay. So if you predict that the price of the asset is going to decline, you can borrow. Okay, you don't even have to own the asset. Okay, you can borrow the asset and then sell here, get 100. Okay. And then if the price indeed declines, you buy back the 100 at 50. Okay. So wherever you borrowed the 100, you give it back, okay, and your profit will be 50, right? It will be 100 minus the 50, and that will be your profits. Okay. So as long as the price falls, you will make a profit. But if your prediction is wrong and then the price rises, then yeah, you'll make a loss, because now you have to buy the same 100 as the same 100 stocks, okay, at a higher price. And yeah, you'll make a loss, because in that case, your selling price is going to be lower than the buying price, okay, and you make a loss. Okay. And if you short sell, okay, you have to hold the asset for some period. Okay. Maybe this was when you sold the asset, and this is when you are buying back the asset. Okay. During this period, okay, if dividends are being paid here, okay, to the original owner of the asset that you've borrowed to sell, if dividends are being paid, okay, within this period by the company to the original owner, okay, you have to pay, okay, that dividends, because you are now, holding the stock temporarily, okay, within this short period. And yeah, you have to give that dividend to the original owner of the asset. Okay. So normally short sales is used, to speculate. Okay. If you predict that the price is going to decline, then you can borrow an asset and then sell it and then make a profit. Okay. So let me stop here for today and continue with how the financial market, okay, works. Okay. And then after here, we will be discussing portfolio analysis and some theories in forming your portfolio. Okay. So let's stop here today. So next time you're going to start with, stop orders. Okay.
Okay, doctor.
Okay. All right. So see you. I think you are saying something.
I've realized we don't, and I was wondering when we would start. Doctor?
Yeah, you were saying something I didn't hear.
Yes. I was saying assessments posted on
Yeah,
Blackboard,
yeah.
so
I'm
we
going
don't
to.
have to go through them in a rush.
Yeah. But the first assessment is not going to be very how do I say it? I'm just in the first assessment, I'm going to make you pick some stocks, okay, from some markets,
Okay.
and then we will, or you will follow, okay, the price of this asset for some period, and then report how the asset is doing over time. Okay. So the first assessment, I will try and post today, but it's not going to be time consuming. Okay. Maybe the second assignment will be case study, but this first assignment is not going to be case study. Okay. And you will see. So I will try and post today or tomorrow. Okay. Yeah, I understand that there is some delay. Okay, so see you next week. Bye bye.
Okay. Thank you, Doctor. Bye.